Sure. Well, I mean, U.S. power demand. I mean, I can speak from a U.S. basis a little bit more granularly than other countries. I'm a U.S. based analyst. Just it's easier for me to talk my book, so to speak. Power demand kind of crawled along, at a minimal growth rate for years and years and years, and then all of a sudden, now with this massive build out of data centers, we're growing at a 2 or 3% clip per annum. At the same time, we've been retiring coal plants for a really long time domestically. And so our baseload infrastructure is not really prepared for this build out. We're going to have to reverse course on certainly the retirements, but also we're going to have to build a lot of new plants, create a lot of transmission infrastructure, and from a regulatory standpoint, have a really good think about how to future proof this. If we really do, as a
Hmm.
country from a national security perspective, want to win the AI Cold War with the rest of the world.
Good day. Today, we are joined by Matthew Warder, aka the Coal Trader, widely regarded as one of the top coal analysts in the world. Matthew, it's an honor to have you on the show.
Hey, thanks for having me. I appreciate you, Steve, and happy to talk to you guys, audience here, a little bit about what's going on in our markets.
Matthew, so I have to ask you, how did you become the Coal Trader? Was it a planned path or did it find you?
Oh no, I took the most circuitous route possible. Went to college on a baseball scholarship with the intention to just major in chemistry and go be a doctor. And then I blew out my elbow my sophomore year and had all this
Eeh.
time on my hands. And I'd always been a musician. I picked up a degree in jazz guitar while I was at it. And while I was studying for the MCAT, and applying to medical school, I started a band called The Argument in Morgantown, West Virginia, which is where I'm from. And then one thing led to another, and kind of shoved off medical school to go chase the brass ring in the music industry, which we got tantalizingly close to, like 3 or 4 times. So our band, The Argument, still plays. So you can find our music on Apple Music and Spotify. We just we've been putting out new songs here over the past couple of years. So it's not like we've stopped doing it. It's just at this point in 2006, it became kind of commercially unviable for us to stay any younger. And so we'd always taught. I
Yeah.
taught in the public school system, and I had a private guitar studio, and I was kind of complaining that I wasn't quite sure what I was going to do after we wrapped up our music career. And then one of my guitar students said, "Well, you could come work for me." And I thought, come help me with hourly work, or make copies, or whatever, edit my stuff. And he came back the next week with an offer for like 36,500, I think it was, and full benefits.
Mhm.
Said, come be my data analyst. I write this study on coal in Central Appalachia, and here you go, take a look at it, see what you think. And so that's how I got started. I just said yes to that job because it still allowed me to teach, and I could kind of double my income and learn a trade on the side. And over the course of the next couple of years, I learned the industry well enough. My dad was happened to be a coal, oil and gas attorney, mostly oil and gas. And so we had a lot of people kind of in the West Virginia community that took me under the wing over the years and kind of showed me the ropes. And a lot of clients that we had. The little firm that I worked for was eventually bought by this big global company, Wood Mackenzie.
Yeah.
And so in the span of like 6 months, I went from being a guitar player to being a global energy consultant. And that
I
was
love it.
that was a baptism by fire. It didn't stop there either. Like, they wanted to digitize we used to publish these tomes. So, most of my generation of analysts took that under their wing, and, we turned it into an online subscription service. I built up all the asset by asset coverage for the Americas for coal. And then they bought this metals consultancy in England, and they wanted to do iron ore and steel. And so I raised my hand to do that, learned how to speak Portuguese, and started going to South America. And I did the same thing
Wow.
for iron ore and steel. So I built up all the mine coverage and the plant coverage for Wood Mackenzie's bulk service over the course of about 10 years. And then realized that all my clients were working on the equity side, and I better figure out how to go do that. And I worked I was director of research for a group of newsletters for a while. Wrote a product with Rick Rule and Sprott that trained me up on base metals, precious metals, uranium and tin and rare earths, and like all these niche metals. Got me kind of like plugged into the C suites And when I struck out on my own, it's like you take all those skill sets and you kind of put them together, and all of a sudden you kind of have this broad knowledge across disciplines where you can kind of understand how things happen, not just in one industry, but like how the entire commodities
Yeah.
sector kind of functions together to create these cycles.
Yeah. So, you know how in movies, certain actors don't want to have, like, I forget what the terminology is, but like, they don't want to be portrayed as the guy who can only play that sort of role.
Mm.
So is like you being the coal trader, the coal guy, is that something that you were happy to get into being like, okay, I'm the coal expert, and so you have a wide, broad range knowledge of everything else, but coal is your baby, and it has been for quite some time now, correct?
Yeah, I mean that's where I started, and it became really clear in the 2021, 2022 timeframe, there just weren't people talking about it in the broader market. So me and a couple other folks on Twitter kind of took that mantle and ran with it, for better or for worse. And what we found was the amount of knowledge sharing that you can get just kind of amplifies your awareness of other sectors as well. And it was really instructive for me to even work with, kind of the generalist and the non-expert crowd, because they perceive markets in ways that, I wasn't necessarily privy to as a mining analyst. And,
Yeah.
what I found is like the more sort of kind of the more we can all kind of elevate to that 50,000 foot level and then have the ability to drill down within one vertical, that's when you get pretty good, not just as one analyst, but kind of as a community of analysts. And it's one of the things I think that, podcasts like your own, and others have kind of brought to light is like the more knowledge we share,
Hmm.
the better we all are all going to be at kind of figuring out what the next 3 months, 6 months, 12 months look like.
Well, Matthew, let's go ahead and start at the 50,000 foot level. If you can give us the
Sure.
big picture of where energy is, where it's going, if it's plateauing, falling, rising, what are you seeing?
Well, I mean, part of that depends on where you are in the world, I suppose, but in general, energy demand is rising. And the fact is, I think most of the fossil fuel analysts, coal and gas and oil, from the beginning of the pandemic and the restart of supply chains and the kind of massive cost inflation that caused during that
Hmm.
period of time. I think we've all been pretty vocal in that when you take supply away, it's very difficult for it to come back, certainly to come back in a timely fashion. And we're still kind of iterating on that lack of supply. So now we're in a more mature phase, and we've added in, at least one wild card for growth, which is artificial intelligence and data center build out, which is occurring. I mean, each market has its own individual peccadillos, but globally, that
Hmm.
is really going to drive power demand. And we don't have, one of our principal criticisms of, whether we call it the Green New Deal or whatever, but the desire to increase reliance on renewables was that renewables aren't dispatchable. So when
Hmm.
demand, rises, there's not extra sun that you can go dispatch. There's not extra wind
Yeah.
that you can go dispatch. You have to burn something, and
Hmm.
turn some turbines and then dispatch that to the grid. So natural gas has served that function for a really long time. And coal and nuclear, we don't have enough baseload power generation capacity to provide that sort of like even floor to prevent blackouts and brownouts when demand is really increasing. And we're going to get into that period before too long with the hyperscalers, certainly in the U.S. But that problem is also going to exist around the world. Other countries are better able to deliver the transmission infrastructure, deliver the generation infrastructure than the United States is, a mature market with a
Hmm.
mature bureaucracy. But I do think you'll see kind of those barriers torn down or adjusted in Western markets over the next few years. I'm not sure we'll see another coal plant built in the U.S., but I certainly think that every coal plant we have will be extended as long as we possibly can, until we can get enough gas plants online to support it. And then,
Hmm.
we're all going to just keep checking our calendars and watches to see when battery storage and grid scale shows up, 2040, 2050, who knows? It's going to be a while.
So, in terms of, you mentioned the word wild card, that being AI. So, when I think about coal, I think about well, renewables are coming. I didn't even like factor in the wild card of AI. So how much wild card is AI in particular to energy as well as particular to specific to coal?
Sure. Well, I mean, U.S. power demand. I mean, I can speak from a U.S. basis a little bit more granularly than other countries. I'm a U.S. based analyst. Just it's easier for me to talk my book, so to speak. Power demand kind of crawled along, at a minimal growth rate for years and years and years, and then all of a sudden, now with this, massive build out of data centers, we're growing at a 2 or 3% clip per annum. At the same time, we've been retiring coal plants for a really long time domestically. And so our baseload infrastructure is not really prepared for this build out. We're going to have to reverse course on certainly the retirements, but also we're going to have to build a lot of new plants, create a lot of transmission infrastructure, and from a regulatory standpoint, have a really good think about how to future proof this. If we really do, as a country from the national security perspective, want to win the AI Cold War with the rest of the world. To go any further than that is, what moves beyond my pay grade. But, from an analyst perspective, it's like, I have to have a number to solve for. And right now, much like the Green New Deal, the numbers that we have to solve for are unrealistic. So, at the end of the day, electric vehicles got the amount of material they got, and that's it. And artificial intelligence isn't going to be any different. You can build out all this compute, but if there's not enough energy to serve the compute, it just serves as latent or fallow capacity. It won't be able to be actuated until you can actually until you can power it. So that's where I think things are headed. Like demand and supply always meet, and much like in the commodities markets, if we don't have enough supply to meet demand, then the arbiter there becomes price, and price is going to go up. So I think we're in a period now through the end of the decade where, broadly speaking, energy prices are going to go up. They're still cyclical. They're not going to go up in a straight line or at a 45-degree angle or anything like that. But I think generally they're going to rise. I think that's generally true of hydrocarbon commodities, and that's even before we get into the flip side. The other side of the coal markets, which has more to do with infrastructure, housing, white goods, those sorts of things, and that's metallurgical coal.
Well, before we get into meta and thermal, I would like to ask what is the supply and demand look like, and not only in terms of the U.S. market, but globally. First of all, who are the major players? And do you see a discrepancy or a difference in terms of demand across the globe?
Sure. That's a big question. We could probably spend an hour just on that question alone and picking out like the little nuances that are probably important to how things progress. But when you talk about the major players, you have to talk about the large integrateds first. That's Glencore and BHP. Glencore is a huge producer of thermal coal in Colombia. But also they bought Teck's metallurgical coal assets in Canada, and so they're a huge presence on both sides of the market. Teck's assets will serve the Asia Pacific basin primarily. So in that market, we've had kind of Chinese steel production has peaked. It is in the process of inflecting to glide lower, and right now, they have a lot of steel inventories that they're pushing out into the market, in the export market, that are keeping global steel prices down. But the next sort of shoe to drop is, as China declines, India's production is going to ramp up. So those two are largely going to offset. And then we have a couple of other things to watch. We have the Russia-Ukraine war coming to an end. For Russia, that may mean a little bit of sort of larger increase in steel production, which may affect prices. But also you have, you're probably going to need to rebuild Ukraine's infrastructure, which will take a lot of steel. And they're probably going to rebuild some plants in Ukraine as well, which will take more coking coal. So, we're in this period where, supply and demand is reasonably balanced right now. But once you get past 2027, 2028, demand begins to creep up again as India grows, but there is zero supply effectively coming on on the met coal side. So for premium products, for premium low volatile coal, which is what we call the benchmark PLV, we think those prices are going to be incredibly resilient from here on out. This year is probably going to be a not so great year. This is the transition year, 2026. Sorry, I shouldn't say this year. It's next year.
Mm-hmm.
But yeah, we think 2027 into the end of the decade, the premium products, low volatile and mid volatile metallurgical coals, which is what their nomenclature is. Those are going to be in pretty short supply. Now the higher volatile coals and lower quality coals, those should be plentiful. So those prices will still stay subdued to some degree, but really the whole market kind of gets priced off of the premium products. So as goes that price, so goes the rest of the market. So that's the met side. On thermal, as goes natural gas, so goes the thermal coal market. So in the same way that steel dynamics are leading indicators of how coking coal markets will perform, power demand and the ability of the world's natural gas production to supply that incremental power demand for the short term at least is going to be the determining factor of coal's path in terms of commodity pricing.
So, Matthew, I think this is a good place as any as to clarify kind of thermal and metallurgical. There's a lot of misunderstanding around coal. Most people picture smoky power plants, but there are really two types, thermal and meta. Can you clarify the difference?
Coal, yeah.
Can you clarify the difference and why it matters for investors today?
It's super easy. Thermal coal goes to power plants to be burned in a boiler to boil water to turn turbines to generate power. So thermal coal is power generation related. Metallurgical coal is used as both the reductant and the fuel for to smelt iron ore, FeO2 in the chemical form to FeO. So the carbon picks off one of the oxygen molecules in iron oxide and releases carbon monoxide, and then the molten FeO is then tapped out and then reduced further to molten iron, which is cast out into ingots, alloyed to make steel, et cetera, et cetera. Coking coals, when you heat them up in the absence of oxygen, make like these charcoal briquettes. Thermal coals do not. Thermal coals turn into dust. So that's the difference between the two of them. Coking coals have these agglomerative properties that have the ability to make charcoal. Thermal coals really don't. There are also some coals that can go into either market that aren't really great coking coals and are sometimes problematic thermal coals because of their agglomeration characteristics, but sometimes those can move into one market or another. Those are called semi-soft coals. In the US we have kind of lower quality high volatile coals that can do that. So but that's the difference, power generation versus industrial manufacturing and smelting. We also use a little bit of coking coal to make silicon metal. We use a little bit of coking coal to make titanium, to make cast iron, wrought iron, and in a couple of other industrial processes as well. So, and then we have industrial coal, which competes with petcoke in the cement industry as well. So those are kind of like higher strength thermal coals. So it's that's the difficult thing I think about understanding the market is like coal isn't one thing. It's many, many things. And each one of those verticals, be it thermal coal, industrial coal, metallurgical coal, they all kind of have their own supply and demand components, and they all have their other fuels that they compete with, or downstream production mechanisms that they compete with. But for our purposes, we'll just go thermal and energy, met coal and steel, and we'll simplify it that way.
So about that, should there be what's the word, bifurcation? Is there should there be like two different like pricing, two different?
There are.
There
yes.
is. Okay. And so when people talk about coal price, how do they differentiate, and what's
the big difference? For thermal coal, it's really easy. Thermal coal is priced largely off of the heat content. So the hotter a coal is, the more it's worth. So like in the US, we have three major regions of production. We have Appalachia, which is very high heat content coal. That
Hmm.
gets, Central App coal, I think, is $81. Northern Appalachian coal is more like 60. We have the Illinois Basin, which is in the middle. It gets about $50. And then we have the Powder River Basin out west, around the Wyoming, Montana. Those heat contents are much, much lower, 8,800 BTUs versus 13,000. So almost half as much thermal content. Those get, $13, $14 a ton. Huge
Hmm.
margins, big margins. On the metallurgical coal side, they're largely priced due to volatile matter. By volatile matter, I mean really what you want in a met coal is the amount of carbon, right? And so
Hmm.
anything that's not carbon that can be driven off in a coke oven, anything that turns to gas is
Hmm.
volatile matter. So if you have, a coal that is 20% volatile matter, you heat it up in an oven and your recovery is about 80% of that coal, right?
Hmm.
So the more fixed carbon you have,
Yeah.
generally the higher the value of the metallurgical coal. Those are the two pricing mechanisms: heat and
Yeah.
carbon content.
So in terms of pricing and in terms of supply and demand, it almost seems like these guys shouldn't. Maybe there's some sort of relationship, but they're like one can go up while the other goes down. The
Sure,
price, so it's like really completely two different things. So you can't really lump coal into one bucket.
can be. Now, the one thing I would say is that although they're separate downstream demand verticals,
Yeah.
um, you have to think about that. You have to remember that steel is still uh, a huge part of like drilling and completion costs for oil and gas, right? So it used to be like when I started as an analyst, I think tube and pipe was about 30% of drill and completion costs. Now I think it's more like 50. So
Hmm.
the higher the steel price is, the higher the cost is to drill for oil, which means the higher the oil price is, which means the higher the diesel price is until something
Hmm.
breaks in that chain, right?
Hmm. Hmm.
So although they don't sometimes directly affect one another, they can. Like for
Like
instance,
a
in polls that can go both ways. If
yeah.
you, if you get a better price on this side, well, you're going to sell over here, which makes less coal available over on the other side, which
Gotcha.
eventually will move prices up. So it's
It's
a
related.
yeah, but all commodities are interrelated. So it's not
Hmm.
just like you solve
Right.
for one variable at a time. It's more like an
Right.
ecosystem where if you take resources away from one area, there will be a new equilibrium that's formed.
Just like natural gas affects the thermal pricing
Mhm.
and supply and demand, as well as the renewables are also related, as we know.
100%.
Uh,
And if you increase oil production, like in the Permian Basin, there's a lot of associated gas production with that. So you get a lot of, call it accidental gas in the
yeah,
market, which
yeah.
will lower gas prices, even though oil prices might still be booming. So there are a lot of instances like that across the commodity markets, and coal's no exception.
So when it comes to, so you said thermal is mostly affected by the natural gas price. That's the
Mhm.
leading indicator, and the metallurgical is from premium products. You said Can you,
Steel.
steel. Okay. And so when we say that India is the the demand for coal is increasing in India and decreasing steadily in China. Why are we seeing a difference? Does that have to do with metallurgical versus thermal? I mean, Why is one decreasing? Why is one increasing? And where is U.S. in all this?
Well, I mean, I think thermal coal demand in China is still increasing, but they produce a lot of it, so they can, just basically force their producers to make more. How they've chose to address their climate issue is to convert their vehicle fleet. They have a command
Hmm.
economy, so they can do that. And electric vehicles run on coal over there,
Hmm.
so they can ramp up coal production, ramp up thermal coal power generation to supply their EV fleet. We don't have the ability to do that. Our market is freer and more complex. There's this command economy, but that's how they've chosen to address that.
Hmm.
So I think thermal coal consumption in China is still, at the very least, steady to slightly increasing. I think we're going to see coking coal consumption in China fall to some degree uh, over the next decade or so.
And India, U.S. and then if you can help me understand, you saying that the U.S. is retiring plants,
Yeah, they have
whereas
been.
it seems like Ukraine war, well, once Ukraine is being rebuilt, is we're expecting more coal plants. Can you help me understand
I don't know
the
if we'll build any coal-fired power generation plants, but we will build another. We will rebuild their steel plants.
okay,
Maybe not all of them, but at least one or two. And once those steel plants are rebuilt, that will increase coking coal demand globally. So that will be a sort of positive inflection, in the market.
gotcha. Well, got a question about coal because I don't really know too much about coal, Matthew. It's
Sure.
something that we don't really is not known as the sexy product. Commodity is just not it's not the first thing most people think of. I gotta have that in my portfolio. With renewables, reshaping the energy market, many assume coal is doomed. So is the decline overplayed? Gradual? Is it more nuanced? And what long term plays exist, if any?
Well, I mean, that's really dependent on how society decides it wants to develop, right? If energy demand growth is going to continue at its pace, then it's not a question of whether you need coal. You must have it, and you probably need to increase consumption of it. Certainly for frontier and developing markets, it's a lot more cost effective for them to burn coal than it would be to burn, to buy natural gas on the international market and build plants that way. So that it's path dependent upon policy at the end of the
Hmm.
day.
Hmm.
Uh, Certainly for Western markets, but if public sentiment goes the way that it has here with Silicon Valley asking for as much energy as they possibly can in order to build out their AI infrastructure, and the governments are compliant with that and go along for the ride, then yeah, we're going to see this what's playing out in the U.S. where we have a rapid increase in apparent demand, but
Yeah.
no material increase in power generation supply. In fact, we're exporting natural gas. That's part of the reason why the gas market is going to tighten over the winter because we got these export terminals coming on. It's great for coal. We're not really going to produce much more coal because we're not building new mines. So the price
Hmm.
for coal will be as elastic as gas allows it to be. But at the end of the day, it's like you buy the companies with prices are going up, and it's hard not to look at the utility sector. It's hard not to look at gas right now. It's hard not to look at the thermal coal domestic producers, which would be Core Natural Resources, ticker CNR, um, uh, Peabody Energy, ticker BTU, and Alliance Resource Limited Partners, ticker ARLP. And those are the three big publicly traded thermal coal producers. A couple of them produce some metallurgical coal as well, but those are the ones who are going to be direct beneficiaries of these higher power prices and higher gas prices. So, to me, like that whole complex is going to improve and probably will continue to improve through at least Q2 of next year.
Beyond Q2, what long-term plays exist for someone who is convinced renewables, or as we talked about the kicker AI, it seems to be affecting coal. And if you can make a case for a bullish coal long term, what would you say?
We don't have battery storage yet. We don't have a replacement for blast furnace production. If a country is growing and their demand for steel-based infrastructure products is growing, i.e., more automobiles, more appliances for increased housing builds, right? Those are you can make those with recycled steel,
Hmm.
but if you're a frontier market or a growing market, you don't have any scrap steel to recycle.
Hmm.
So, the moral of the story is, as a friend of mine on Twitter has put it a couple of times, you can't recycle your way to growth. Uh, that's a I mean, it's funny because it's true,
Hmm.
right?
Yeah.
There's no way to really do that. You have to create some degree of virgin material in order to fuel that growth. And 20 years from now, maybe you can have a scrap market with that build out. But right now,
Hmm.
in the US, we've already done that. We did that in the
Hmm.
1800s and 1900s, and fought 2 world wars. There's a lot of scrap steel
Yeah.
in the United States, and the barrier to entry is effort. But Europe doesn't have that developed of a market. China certainly doesn't yet either, although it will probably 20 years from now. So, those are things that develop over time. Um,
Hmm.
and then similarly, on the battery storage side, we don't have dispatchable technology that works at the grid level. We could have a lot of distributed solar that helps out with individuals' power demand at their own homes. But right now they don't really have the ability to sell that power back into the grid and make money for themselves. We don't have the ability to use that generation and dispatch it back into the wider grid. So like those are things that we could try to do from a technological
Hmm.
perspective to sort of future proof our energy infrastructure into being able to do that and empower our citizenry at the same time. But we're not having those conversations. So, at the policy level, it's going to be dependent upon who's got the ear of the people who make the rules. Right now, it's Silicon Valley,
Hmm.
and they're saying, give me as much baseload power as you can. We're going to throw as much as we can behind nuclear. And what we're going to find is that's going to go really slow.
Hmm.
Not because we don't want to, because it is what it is. So, as my mom used to say when I was a kid, you get what you get, and you don't get upset. That's the reality for whether we're talking about electric vehicle growth,
Yeah.
grid scale battery storage, um, steel production growth. If we
Hmm.
want to grow GDP, you need materials in order to be able to fuel it. And right now, the society has not invested in those materials for the last 20 years. And I'm sure you've
Hmm.
had conversations with folks on the copper side or
Yeah.
uranium, or just insert commodity here. It's a
Yeah.
common theme across the space, and our body of knowledge that we have as analysts is is not held by a whole lot of people in the world. So this is a pretty important decade for us to get the word out, in formats like this and certainly in others. So uh,
I want to go back to the AI conversation and thinking about framing baseline bullish, bearish scenarios, and kind of like you mentioned the word wild card. Like, how do you see AI disrupting, affecting coal in particular? Do you see a scenario where it completely changes the trajectory of where coal uh, might go?
well, I don't think we can change the direction of it without increasing supply. I mean, what changes is the direction of pricing, at the end of the day. If
Hmm.
natural gas can't supply all of that demand and we
Yeah.
can't build out the transmission infrastructures, well, just the price is going to go up. We're not going to really produce any more. There aren't a whole lot of projects in the works. There are some that maybe could, some brownfield operations that we could maybe bring online. But I mean, you can count on a couple of hands, the number of shovel ready projects like those there are in the US anyway. Around the world it's a little bit more complicated picture, but the theme is the same. If you increase demand to the point that where supply can't keep up, then prices are going to rise for everything. We saw it in post COVID. That was the restart of the supply chains, but it's the same theme. You
Hmm.
can't get more stuff quickly. Could we change that? I suppose. But so far, you know, all it seems the policymakers want to do is just throw money at the problem. That helps. And believe me, the mining
Yeah.
industry, the coal industry, everybody's happy to see it. When 4 years ago we were having conversations about how you might not be able to find financing again for a coal mine, and here it turns out the banks kind of want to do it again. So I don't think finance is going to be the limiting factor. I think it's just going to be willingness, the political will to be pragmatic and do what is necessary to fuel the demand that you claim to uh, prioritize over all else. And that's a human question. It's not something you or I or anybody can really answer, but
Yeah.
that's the crux of it right there.
So the political demand, with the current administration talking about bringing things in-house and, backing, it seems like nuclear is getting a lot of benefit and love. What kind of posture is the government having towards coal? And when I hear retirement,
Mhm.
retiring coal plants,
Yeah.
and I hear current administration saying we got to bring everything in house. If you can help me
Mhm.
make sense of that.
Uh, well, I mean, they've already kind of just stopped retiring. Certainly under this administration, that's going to be the case. But the difference I think between now, I have an office in DC. I have, the bare minimum of general conversations with, folks who are on the either the policy side or in the bureaucracy infrastructure. The difference I think now is that uh, it wasn't a bipartisan discussion in 2021 or 22. Uh, it seemed to me then, and I don't want to put words or intentions in anyone's mouth, that it was accepted that we could just do what we wanted to do in terms of we're going to create all this, demand for electric vehicles. We're going to force the market, and just blew up in their face. It didn't work. We all, the analysts knew that was going to happen. We
Hmm.
tried to tell anybody who would listen. We were waving our hands on Twitter. I was getting ready to send out smoke signals, and you can't get there from here. Like the process to electrify everything isn't a 10-year project. I mean, setting
Hmm.
10-year goals for climate or 20-year goals for climate. Good Lord, like what a fool's errand that is. Like that has to take place over generations, and you can't go from step one to step 100. You have to go from step one to step two.
Hmm.
And as much as they would like to stop using coal at the rate that we were using in the past,
Yeah.
without a ready dispatchable replacement for baseload power demand, it was just not possible. And that was the what's the opening line in The Big Short? It ain't what you don't know that hurts you. It's what you know for sure that just ain't so. And that was what how I
Hmm.
would characterize 21 and 22. Fast forward to now, I just went to a critical materials conference in DC last Tuesday. Um, Senator Hickenlooper, Democrat from Colorado, and Senator Todd Young, a Republican from Indiana, got on stage together and said ostensibly the same thing with regard to critical materials, of which, both of them I think would consider at this point metallurgical coal to be one. Maybe not thermal coal yet. We still do export a lot of met coal too. But if steel is critical, then met coal is critical. And when we decide that energy is also critical, well, guess what? We're gonna wind up in that position, and it's going to wind up being a bipartisan view. It's not going to be separated by ideology anymore.
Hmm.
And for those of us who when you sit down to be an analyst, regardless of what your political affiliation is, you're solving for correct answers. And you know we have the ability to be objective like that and try to have difficult conversations with policymakers. But if they don't accept that, then
Hmm.
what do you do? I mean, all you can do is just shrug your shoulders and let them, make mistakes. And because making mistakes, oddly enough, is the only way you get new law that works. So we're in that process. I wouldn't say there's been a come to Jesus moment
Hmm.
about coal or about materials in general, but the conversation is warming, and certainly they have at least unlocked the coffers of the government to allow for financing of operations, which is, I don't know how much of that coal is going to get, but it is a welcome sign to the mining
Hmm.
industry in general to see. I'll sort of leave it at that. I don't want to be, uh,
Yeah.
that problem that you're talking about is much bigger than just coal.
Yeah.
And coal is going to benefit from it. However, it's a 50,000 foot conversation with 5,000 foot effects. And
Gotcha.
if you understand the framework, you can get back down to the micro pretty easy.
Matthew, is now the time to avoid selectively invest, focus on specific regions? I mean, how would you recommend constructing a coal portfolio right now? I mean, where should investors even start?
Well, I mean, I think I think the divisions that I laid out before. On the met coal side, the ability of China to ramp down and India to ramp up. That is contingent on China's steel inventories get pulling back to normal levels and their
Hmm.
exports pulling back to normal levels. Once that happens, India will have the ability to grow, and we should see coking coal prices begin to cycle back up again, particularly on the premium side. We want to be long low vol and mid vol producers, which would be companies like Warrior Met Coal, HCC in the U.S., uh, Alpha Metallurgical Resources, ticker AMR in the U.S. Overseas, uh, Whitehaven on the Australian exchange is going to be a huge benefactor of rising met coal prices as they digest their acquisition uh, from BHP not too long ago. Glencore is going to be a huge beneficiary once they pay off the earnout from Teck's Elk Valley Resources. Um, and then on the thermal coal side, I listed the U.S. companies that are of most interest, and I can go back and talk about their individual outlooks here in a second. But we need to mention Yancoal, mostly a thermal coal producer in Australia, huge dividend, very, very low cost, Chinese owned, but I think that kind of ensures a dividend over time. Stanmore Resources, which produces, not premium met coal, but has a really excellent cost structure and is at these lower prices is undervalued relative to their peers. That's ticker SMR. New Hope, NHC on the Australian exchange, thermal coal producer primarily. Also pretty good cost structure. It's pretty attractive only because it had gotten beaten down along with some other names as international gas prices fell earlier in the year. It's pretty attractive where it is. That's kind of the universe in which we function. Those are the highest liquidity companies. I think if I had to rank them right now, I think probably Core Natural Resources and Whitehaven are
Hmm.
probably at the top of my list. Both will have buybacks that are working as prices for their products begin to ramp up. On the pure play met side, I think that inflection is probably going to take place in late 2026, so call it Q3, Q4. And that should move slowly through 27 and accelerate into the last half of the decade. So, AMR, we want to start to build positions in, I think, by the middle of next year, should be a good point in time to begin kind of targeting them for a larger position. Warrior Met Coal is expanding production, so they're okay to own here at the moment. But again, I think domestic thermal coal, which Core Natural Resources produces, Alliance Resource Limited Partners, Peabody Energy, ticker BTU. They also have a met coal mine in Australia that's coming online. I think those are probably where I'd allocate resources first. If you're looking right now as opposed to 6 months from now. I think the U.S. domestic guys are going to have a really good 2026. I think the global met guys are going to have a really good 2027.
Matthew, if you can, thank you for first of all giving us those companies to look at. But if you can tell us a bit about the Coal Trader, the services you
Sure.
offer, how listeners can find you online and social media.
Sure. Well, first off, you can follow us at thecoaltrader.com. We offer subscriptions directly to our website there. An annual premium subscription there gets you not just access to our Substack, which is thecoaltrader.substack.com, but also to our deep dive company analyses. Starting next year, we're going to actually publish models. We have financial models for most of the companies. For the most part, we've just published those in pieces to date,
Hmm.
but we're going to try to make those available online to premium subscribers starting early in the year. That's going to be a new feature. On Substack, which is where we do most of our kind of day-to-day conversations, I have a daily note that comes out on met coal pricing every day, where we kind of take a look through all the global markets and then also through the equities. If we put out buy alerts or trade alerts. We put that out usually in the chat. And then we have these longer form pieces that appear in the Substack. All of this gets mirrored also over to the website. But yeah, I think starting next year, we'll have additional resources available for premium subscribers on the website. You get the Substack for free, but Substack only subscribers are going to get some semblance of that as well. So we try to have kind of equal opportunities on both sites. So it's thecoaltrader.com and thecoaltrader.substack.com. And of course, you can always just follow me on Twitter at MFWarder as well.
Okay. For everyone listening, we'll include Matthew Warder's thecoaltrader.com, the Substack, and his socials in the show notes. For everyone, thanks for listening. I'm Steve Yang, learning alongside you from people smarter than me. Stay smart, stay curious, stay disciplined. Matthew, thanks again for being here and sharing your knowledge and informing me and hopefully others about coal and giving your perspective.
All right, Steve, I appreciate you. Thanks for having me on. And as always, to your crowd over there, it's great to talk to everybody again. And please reach out with any questions.
Thanks, Matt.
Thank you.